Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive. Today, we are breaking down the undisputed king of streaming, a company that has, well, reinvented itself yet again. Netflix. Now, on the surface, Netflix looks invincible. I mean, we're talking about over 300 million subscribers, a global dominance that feels absolute. But the real question for us as long-term investors is this. Is Netflix simply a mature utility now, destined for slow growth? Or does the market's fear of saturation hide a massive compounding engine that is just getting started? That's what we're here to find out.
It's a huge topic. Well, before we dive deep, a quick heads up for the audience.
Right, if you're looking to invest, we use Interactive Brokers. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time.
And while you're there, please like, subscribe, and let us know your questions in the comments.
Now let's get into it. Pillar number 1, the business engine and economic moat. You framed this in the intro as a question of stalling versus compounding. But I kind of want to push back immediately on the idea that this is just about subscriber count. I mean, we've seen high subscriber businesses collapse before. We need to look at the mechanics. How do you actually view the core cash engine right now in 2026?
You're so right. The subscriber headline number is it's a vanity metric if the unit economics don't work. And to understand the engine, we have to look at the negative working capital dynamic. This is something most media analysts honestly still get wrong. They look at the P&L and see amortization, but they completely miss the cash flow timing.
Okay, walk us through the cash timing, because usually negative working capital sounds like a bad thing to someone who's not initiated, like a liquidity crisis.
Yeah, it's counterintuitive, but it's actually the holy grail of business models. Think about Amazon. Amazon gets paid by you today, but pays its suppliers maybe 90 days later. Netflix has engineered a very similar dynamic, but in media. The subscriber pays, $17 or $23 for their monthly fee upfront? That hits the bank account on day one. Netflix, however, pays for the production of Stranger Things or Wednesday over a multi-year period. The cash goes out in milestones, spread out over maybe 3 to 4 years.
So they're effectively floating their entire operation using the customer's money.
Precisely. They are investing your subscription fee from today to build the asset that keeps you subscribed next year. It creates this virtuous cycle where the cash inflow comes way before the cash outflow. And this allows them to dump massive liquidity into the content spend bucket, which is capped at roughly $17 billion now, without having to tap the debt markets like they did back in the 2010s.
Okay, but here's the problem with that model, or at least the perceived problem. It works when you are growing. It works when that flywheel's spinning fast. But we are in 2026. The landscape is crowded. You have Disney, Amazon, Apple, the remnants of the cable bundle. The bear case for the last 3 years has been that Netflix has zero pricing power left. If they raise prices to keep that cash float going, people will just churn and go to Disney Plus bot fight.
That was the thesis. And frankly, it was a logical thesis. It made sense on paper, but we have to look at the data. We have to look at what happened with the pincer maneuver of 2024 and 2025. This was the ultimate A/B test for pricing power.
I remember the headlines. The end of Netflix. The great unsubscribing. It was everywhere.
The sentiment was absolutely toxic. They did two things that, in theory, should have killed demand. First, the password crackdown. They forced 100 million borrowers to pay up or get out. Second, they raised prices on the premium tier by nearly 15% in key markets like the US, UK, and France. I mean, Economics 101 says if you increase friction and you increase price, demand collapses.
So why didn't it, and I don't want the qualitative, people love the shows answer. What did the churn data actually look like?
And the churn data was the smoking gun. It really was. In Q2 and Q3 of 2024, right when the crackdown was at peak velocity, monthly churn in the US and Canada region didn't spike to 4 or 5% like the bears predicted. It stayed incredibly sticky, just hovering in that low 2% range. But even more important was the borrower conversion rate.
The ratio of people they kicked off to people who signed up for their own account.
Exactly. The Wall Street expectation was maybe 1 in 10 borrowers would get their own account. The data suggests it was closer to 4 or 5 in 10, a huge beat. And for those who didn't sign up, the primary account holder didn't cancel in protest. They just grumbled and paid the extra member fee. And all of this drove the average revenue per membership, the ARM, up significantly. It proved that Netflix isn't a discretionary nice-to-have anymore. It behaves much more like a utility.
Okay, I'll grant you the utility argument. Once you have the habit, it's a very hard thing to break. But let's get back to the competition. You mentioned the $17 billion content spend. You've called it a mathematical wall before. the content cost arbitrage.
It is a wall, a vertical one.
But isn't that just a function of having more money? I mean, if Apple just decides, you know what, we're spending $30 billion, does the wall crumble?
No, it doesn't. Because Apple doesn't have the user base to amortize it across. This is the single most important math equation in the entire media industry. Let's use a hypothetical blockbuster in 2026. High production value, A-list cast. Let's say a total budget of $200 million.
Yeah, that's pretty standard stakes for a flagship series these days.
Right. So Netflix creates this asset. They distribute that $200 million cost across a base of 301 million paid memberships. The cost per subscriber for that specific asset is roughly 66 cents.
66 cents for a massive show.
Now, look at Paramount plus Ma or Peacock, or even some merged entity that has, say, 50 to 60 million real non-bundled subscribers. To compete on quality, they must spend that same 200 million. The camera doesn't charge you less just because you have fewer viewers. The actors don't take a pay cut. So for that competitor, that same show costs them somewhere between $3.30 and $4 per subscriber.
Wow, that is a 6 times disadvantage on the unit economics.
It's lethal. It is absolutely lethal. It means the competitor has two choices. Option A. Spend the money to match the quality, completely destroy your margins, and bleed cash until your shareholders revolt. This is what we saw Paramount do for years. Option B. You cut the budget to fit your user base. But if you spend $40 million instead of $200 million, the show looks cheap. It looks like old school cable TV. And then your subscribers churn out because the quality just isn't there.
It's a catch-22. You can't grow without spending, but you can't afford to spend until you grow.
Exactly. Netflix has escaped the media industry's gravity. The others are still fighting it. And that really brings us to the Lollapalooza effect. This isn't just one number, it's the convergence.
Mumbler's concept.
Yes. You have the scale economies, the 66 cents versus $4, that's number one. Then you have the psychological habit, the availability heuristic, where Netflix is literally a synonym for watching TV. And then you have the data feedback loop. Because they have 300 million people watching, their algorithm is training on a data set that is 6 times larger than the nearest competitor.
Which means the algorithm gets smarter faster.
Right. It predicts what you want to watch next with much higher accuracy, which lowers your churn, which increases your lifetime value, or LTV, which then gives them more cash to spend on content. It's a self-reinforcing compounding machine.
Okay, I'm going to stop you there. We've established the machine works, the engine is beautiful, I get it. But as an investor, I don't buy engines, I buy cash flows. And historically, Netflix has been a company that produces a lot of accounting profit but burns actual cash. We need to move to pillar 2, financial resilience and capital allocation.
Okay, let's get into the numbers.
I want to focus on the quality of earnings. For a decade, the bear case was, they claim they are profitable, but they are borrowing billions to make shows.
Mm-hmm.
Here in 2026, looking at the 2025 full-year results, has that actually changed, or are they still playing accounting games?
That narrative is dead. It's over. The cash burn era is history. If you look at the trajectory, operating margins hit roughly 28% in 2024, and they are guiding north of 29% for 2025. But the most important metric really is the convergence of net income and free cash flow. They're finally moving together.
But is that free cash flow real? We see this in Silicon Valley all the time. Companies report record free cash flow. But if you look at the stock-based compensation, the SBC, they're essentially just paying their employees in dilution rather than cash. If you strip out SBC, what does Netflix actually look like?
It's a totally valid critique for, I'd say, 90% of the tech sector. For Netflix, SBC runs about 3 to 4% of revenue. So it's significant, sure. We're talking a couple $1 billion. However, unlike a Snowflake or a Palantir where SBC wipes out the entire profit, Netflix is generating substantial owner earnings even after you subtract the SBC as a real cash cost.
So if I treat SBC as a cash expense, which I should, they are still printing money.
Absolutely, because revenue is growing in the double digits, but the cash content spend is capped. It's capped at $17 billion. That is the lever. Every dollar of revenue growth above that fixed cost base flows almost directly to the bottom line. They aren't scaling costs linearly with revenue anymore. That phase is over.
This brings us to the report card. Management has a lot of cash now. They aren't going to the debt markets begging for money. They are sitting on a pile of it. How they spend that money determines if this is a $100 stock or a $200 stock. What is the ROIC telling us?
The return on invested capital is sitting at approximately 24%.
Let's put that in context. The S&P 500 average is usually what, mid-teens?
Right, and their cost of capital, their WACC, is maybe 8 or 9%. So they have a spread of 15 points. They are creating massive value. But compared to old media, it's even more stark. I mean, if you look at the ROIC of a Warner Bros., Discovery, or a Paramount, dragged down by declining linear assets and all that debt, they are struggling to even clear their cost of capital. Netflix is in the elite compounder tier.
Okay, so what are they doing with all the excess cash?
The hierarchy seems very strict. First, reinvest in the business up to the optimal level, and that's the $17 billion content cap. They figured out that spending $20 billion doesn't necessarily yield more subs than $17 billion, so they discipline themselves there, which is impressive. Second, buybacks.
The cannibal factor.
They are being aggressive. They repurchased 3.6 million shares back in Q1 of 24 alone. They are systematically reducing the denominator. This is huge for EPS growth. If your revenue grows 12%, but you retire 3% of the shares, your earnings per share grows 15+%. It's just math.
There is a third option for capital allocation, though. And this is usually where CEOs get bored and start destroying value. M&A.
The institutional imperative, the urge to do something.
We're seeing rumors again. There are always rumors. Netflix should buy Paramount. Netflix should merge with WBD.
It's the single biggest red flag of the whole thesis.
We'll drill into that in the risk section, because I agree, I think it's the biggest threat to the stock. But strictly on a backward-looking basis, their capital discipline has been an A-. They haven't done a stupid deal yet.
That one word is doing a lot of work. And that constraint is what keeps the ROIC high.
Okay, so the backward-looking financials are solid. But the market is a forward-looking discounting mechanism. We have to talk about Pillar 3, growth, valuation, and fair value. The stock is trading around $83.54 post-split adjusted. And the PE is about 26 times.
Which is basically average.
It's barely above the market multiple. For a company that completely dominates its sector, that tells me the market thinks growth is over. They think everyone who wants Netflix already has Netflix. Where does the growth come from? Are we just squeezing the lemons at this point?
See, that's what I call the saturation fallacy. The market looks at households and thinks, okay, 300 million households, we're running out of humans with internet.
Yeah.
But they are ignoring the two massive engines that detach revenue from just the headcount.
Let's break them down. Engine number 1, advertising.
The ad tier. We are looking at over 70 million monthly active users, or MAUs, on this tier now. But here's the secret sauce that I think people miss. The ARPU on the ad tier is often higher than the standard subscription.
Explain that math, because usually ads are the cheap option for the consumer.
The consumer pays less, let's say $7, but the ad load, the CPMs Netflix charges advertisers, is premium, extremely premium. Because Netflix has 100% verified logged-in user data, they can target ads better than any linear TV network could ever dream of. So they might get $15 in ad revenue per user on top of that $7 subscription. That totals $22. Compare that to a standard plan at $15.50.
So in some cases, they actually want people to churn down to the ad tier.
In many markets, yes. It's accretive to revenue. It creates a much higher ceiling for monetization. They don't need to find a new subscriber in India. They just need to monetize the existing viewer in Ohio more effectively.
Okay, what about Engine 2? Live events, the WWE deal, the NFL Christmas games. I've seen a lot of analysts dismiss this as a loss leader, just a big marketing expense to get headlines.
It's not a loss leader. It's a churn killer. Think about the psychology of cancellation. You finish Bridgerton, you look at your credit card statement, you say, I'll cancel for a few months and come back when Squid Game returns. That behavior is the mortal enemy of the compounding model.
But if the NFL game is on Christmas Day,
or if Monday Night Raw is on every single week, 52 weeks a year, you can't cancel. It converts Netflix from a library, which you visit occasionally, to a utility, which just flows into your house daily. You don't cancel your electricity bill because you didn't use the lights much this month. Live sports creates that same kind of floor.
it creates a bundle without all the baggage of the old cable bundle.
Exactly. And that reduction in churn, even a small one, has a massive impact on lifetime value. If you increase the average subscriber life from 20 months to 30 months, the intrinsic value of the business jumps 50% overnight.
So let's plug those assumptions into a valuation model. You said 26 times forward PE. If I believe the ad tier increases ARPU and sports reduces churn, that multiple looks, well, remarkably low.
It's priced as a mature stalwart. The market is treating Netflix like it's Cisco or Oracle, a safe, boring, slow grower.
But you think it's still a growth stock?
I think it's a compounder. Let's just look at mean reversion. Netflix has historically traded at 30 to 40 times earnings. If we assume a modest mean reversion to just 30 times, and we apply that to the 2027 EPS estimates, which are sitting around $4 per share in this adjusted view, you get a stock price of $120.
That's nearly 50% upside from 83.
And that's not requiring a miracle. That's just requiring the multiple to drift back toward its historical norm as the ad revenue really kicks in. Even if we use the owner earnings method, the super conservative Warren Buffett-style approach, stripping out everything, using a 20 times multiple, we land at $95.
So the floor is 95, and the reasonable upside is 120 plus, and we are trading at 83.
It's a classic margin of safety. The risk to reward is skewed heavily in our favor right now.
Okay, risk. Let's pivot. Because my job is to tear this whole thing apart. You've painted a very rosy picture, but businesses this big have failed before. I want to talk about Pillar 4, the Premortem.
Hit me.
I see two existential threats. One is internal, one is external. Let's start with the internal one, the diversification trap. We touched on the WBD and Paramount rumors.
This is the nightmare scenario.
Explain why. If Netflix buys Warner Bros., they get HBO, they get Game of Thrones, they get the DC universe. On paper, that sounds like a content fortress. Why is that a bad idea?
It's poison, pure and simple poison, because you aren't just buying the IP, you are buying the structure. Warner Bros. Discovery is loaded with debt. They own declining linear cable networks, CNN, TNT, TBS. These are assets that are literally shrinking 10% a year.
Cord cutting is accelerating, not slowing down.
Right. If Netflix buys them, they inherit that decline. Management suddenly has to spend 40% of their time managing a dying cable business instead of focusing on streaming. It absolutely dilutes the ROIC. It changes the capital structure from cash-rich to debt-heavy.
So it's the difference between a speedboat and an anchor.
Exactly. And there is an ego component to it. CEOs love big deals. It gets them on the cover of magazines, the merger of the century. But for shareholders, it's almost always value destructive. If I see a headline, Netflix acquires Warner Bros., I am selling my entire position that morning. No questions asked.
That is a very strong statement. An immediate sell.
Immediate. It completely breaks the thesis.
Okay, let's look at the external threat. And this one is trickier because it's much harder to quantify. Generative AI.
The Sora problem.
Yeah. In the intro, we kind of breezed past this, but we need to really dig in. We have all seen the demos. Sora V3, Runway Gen 4. The video quality is, well, it's indistinguishable from reality now. The argument is this. Netflix's moat is that high-quality content is expensive. If AI drives the cost of production to zero, does the moat just evaporate?
This is the 10-year existential question. If a kid in a basement in Mumbai can generate a season of Stranger Things quality video for $500 in compute credits, why does Netflix need to spend $17 billion?
And why do I need to pay Netflix $23 a month?
So here is the counterintuitive take. I actually think AI strengthens Netflix in the medium term, but it threatens them in the long term.
Walk me through the medium term. How does it strengthen them?
Legal moats and copyright. Netflix owns the training data. They have the largest library of high-quality, copyrighted video in the world. If they build their own internal models trained on The Crown and Ozark, they can lower their own production costs. They can fix bad lighting in post-production for pennies. They can dub shows into 40 languages instantly with perfect lip sync.
So it improves their margins first.
Right. It makes the $17 billion spend go even further. They get more output for the same input. Also, the copyright laws are going to be a complete mess for years. If that kid in the basement makes a movie, can he copyright it? Can he monetize it? Or will the platforms block it? Netflix becomes a gatekeeper.
But let's look further out. The democratization of content. If YouTube gets flooded with AI-generated movies that are actually good and free, doesn't that fundamentally devalue the premium subscription model?
It creates a noise problem. If there is infinite content, curation becomes the scarce asset. You need a trusted filter. Netflix becomes the Michelin guide. You pay them not just for the content, but for the assurance that the content is actually worth your time.
That's a dangerous bet, though. Relying on being a curator is a much weaker moat than being the only manufacturer.
I agree. It's a definite risk. If the barrier to entry for creating a blockbuster drops to zero, the entire content industry becomes a commodity market. And in a commodity market, prices always crash. This is why I watch the AI developments much closer than I watch the quarterly subscriber numbers now.
Okay, so bringing this all together for the synthesis,
Right.
How do we score Netflix in 2026?
Quality score. I'm giving it an A-. And I'm deducting points solely for the potential risk of a bad M&A deal. The core business itself is an A+.
And the valuation score.
Cheap. It's just cheap. It's a rare dislocation. You're getting a monopoly-like asset at a market average multiple.
So summarize the thesis for the listener who might still be on the fence.
The bull case is the utility phase. The ad tier and live sports create an impenetrable bundle. Churn drops, pricing power holds, and the operating leverage combined with the buybacks drives EPS to $5, $6, $7. The stock just follows the earnings up.
And the bear case.
The hubris trap, they get bored. They buy a dying media dinosaur like WBD or Paramount to save Hollywood, and they destroy their balance sheet in the process. Or the other risk is that AI moves way faster than we think, and the value of premium video collapses to zero.
So it really just comes down to discipline. Can they just sit there, run the engine, and buy back shares?
It sounds so easy, but in the corporate world, doing nothing is often the hardest thing to do. And that leads me to my final thought for everyone listening. We often spend so much time analyzing competitors. What is Disney doing? What is Apple doing? But the biggest risk to Netflix is Netflix. The real enemy is their own boredom. If they can resist the urge to empire build and just focus on being the best streaming utility on earth, the stock is a double from here, maybe more. If they give in to the urge to do the big deal, it's over.
A powerful note to end on. If you enjoyed this breakdown, check the link for Interactive Brokers below. We'll see you in the next deep dive.
Happy investing, everyone.